9 trading days, 294 million ounces of paper silver still open, and the banks are on holiday. If you think that's a coincidence, you haven't been paying attention long enough. What's happening right now in the silver and gold markets isn't noise, it's a signal. And once you see the mechanics behind it, you can't unsee them. Stay with me, because by the end of this, you'll understand exactly why the people who've been calling this a bubble might be the ones who end up most exposed. Let me be clear before we go any further. I don't sell courses, I don't run signals, I don't have a mentorship program. What I do is show you the data, give you the sources, and let you make your own decisions. This is financial warfare education, not financial advice. The establishment, the mainstream banks, corporate media, they profit directly from you staying uninformed. So if you're new here, do what the smart ones do. Don't trust me either. Go check the numbers yourself. If they hold up, you'll know why you're here. Now let's get into what's actually happening. The March silver contract has 59,000 open positions, with only 9 days left before first notice day on February 27th. That represents 294 million ounces of paper silver still sitting in contracts that should, by historical norms, be rolling off into the next month. Instead, 57% of open interest stayed put. Only 43% rolled forward to May. That divergence from normal behavior is the first signal worth watching. Historical delivery averages sit around 4.9% for silver, but recent numbers are running closer to 10 to 13%. Even at the conservative historical average, we're looking at 29 million ounces demanded against 90 million registered at the COMEX. That's technically manageable, but we're in the 6th consecutive year of structural deficit, with Eastern buyers paying $10 premiums for physical metal. The math is tightening in ways that normal delivery cycles never had to account for. The East-West price divide is no longer subtle. Shanghai silver spot is trading at $86, while Western spot sits at $76. That's a $10 premium that has held steady despite Western consolidation, and it tells you everything about where physical demand is actually coming from. When Asian markets knock price down $2 in minutes at the open, Middle Eastern and European buyers come in and absorb it. Silver is reportedly selling out in Dubai. These aren't retail tourists buying coins. These are sophisticated buyers with agents operating worldwide. The physical market in the East is treating every Western paper rate as a buying opportunity, and that structural demand is blunting the kind of sustained downside that paper manipulation used to be able to create without resistance. The media's role in price action deserves serious examination. Bloomberg published multiple bearish silver headlines during the worst sell-offs in early February, including a story about Russia potentially returning to dollars published right before silver dropped from $85 to $74 in under an hour. The timing of these headlines coinciding precisely with algorithmic sell triggers is a pattern that has been documented repeatedly. Large financial media, Bloomberg and Reuters among them, have been used to create fear-driven selling where algorithms react to headline sentiment before human traders can analyze the actual substance. That's not conspiracy. That's a documented trading mechanic that benefits anyone positioned short ahead of the headline drop. The Chinese silver fund collapse exposed something important about how structured vulnerabilities get exploited. A Chinese fund manager is now compensating investors after a 31.5% valuation-driven drop between January 30th and February 2nd. The SHFE's 17% daily price limits prevented the fund from executing exit trades during extreme volatility, creating a mechanical trap. Swiss analyst Yves Steger called the January 30th crash the biggest $100 billion fraud of all time, noting that 1.83 billion ounces of paper silver traded that day while zero physical moved. Shanghai premiums exploded to 40% during the crash, while COMEX collapsed, showing the paper and physical markets moving in opposite directions simultaneously. China responded by banning naked shorts and pursuing 180 enforcement cases, doing, as Steger noted, exactly what regulators are supposed to do. Ray Dalio's 500-year historical analysis places America firmly in stage 6 of a 9-stage debt cycle. Federal debt exceeding 120% of GDP, money supply expanded 40% since 2020, wealth concentration at century highs, and rival powers building parallel financial infrastructure. These aren't political talking points. They're measurable cycle markers. Stage 6 presents only 2 exits: let rates rise and crash the economy, or print money and create inflation. Both destroy wealth, just through different mechanisms. History shows these cycles resolve 90% of the time through conflict or massive restructuring, not because humans are inherently violent, but because debts become mathematically impossible to service when internal inequality peaks and external rivals emerge at the same time. China's financial ambitions aren't about replacing the dollar with the yuan. They're about building an entirely separate order. Production over speculation, society over shareholders, capital flowing in rather than hollowing out. China already dominates the physical economy through manufacturing, supply chains, and trade. The next phase is financial dominance, and it's already underway. Combined Chinese metals futures volume jumped 86% month over month in January to 78 million lots, 5 times the average monthly volume from the previous 11 months. Metals have become the most popular trade on Chinese social media, as Eastern retail participants increasingly view physical commodities as protection against currency debasement and geopolitical risk. That's not speculative positioning. That's a structural shift in who controls price discovery. The mathematical case for gold and silver doesn't rest on hope. It rests on ratio analysis with 100 years of historical data behind it. The Dow to gold ratio currently sits at 982. A decline to 2.5, not an extreme target, just a historical swing from one excess to another, implies gold at $19,800 if the Dow holds flat near 40,500. Apply a conservative gold to silver ratio of 19, not normalization, but a historical cyclical swing, and silver targets 142. Jim Rogers, co-founder of the Quantum Fund, which gained 4,200% between 1973 and 1980, hasn't sold a single ounce of gold or silver. He's been buying on dips and says he hopes his children inherit the stack. When sophisticated capital with decades of cycle experience is positioned this way, the ratio math and the behavioral signal are pointing in the same direction. Dollar sentiment hitting a 14-year extreme in short positioning is the final piece of the setup. Fund managers' dollar exposure has dropped below last April's lows. Short bets against the dollar are now at their highest since January 2012. This creates a binary outcome. Either the economic data validates the bearish thesis and the structural dollar decline continues, or the data diverges from consensus and you get a violent short squeeze that forces mechanical covering. Either way, you're watching the positioning of major players who've already made their bet on reserve currency stress. When you combine that with parallel financial infrastructure being built systematically by rival economic powers, the stage 6 markers Dalio identifies stop looking theoretical and start looking operational. Here's what the data shows when you strip the noise away. This isn't about predicting the exact day or the exact price. Markets can stay irrational longer than you can stay solvent. That's a real risk, and it belongs in every honest analysis. But setups don't announce themselves. They reveal themselves through divergences. 57% of open interest refusing to roll, delivery percentages running double historical averages, a $10 east-west premium that won't compress, a media timing pattern that benefits short sellers, China enforcing rules that Western regulators won't, and sophisticated capital quietly building asymmetric positions in far out-of-the-money gold calls that only pay off in a monetary crisis. The probability matrix has shifted. That doesn't mean act on emotion. It means understand the mechanics, verify the sources, and make decisions with logic. The data is in front of you. OG out.